Good afternoon to all of you. First of all, let me have the pleasure of welcoming this prestigious audience gathered here today for this special public lecture on monetary policy in a changing world, which is to be delivered by Dr. Krishnamurthy V Subramanian, Executive Director of International Monetary Fund. Today we have an audience consisting of senior professionals of the financial industry at the atrium of Central Bank. Apart from that, we have quite a large audience joining with us virtually via Zoom platform and Facebook. We are so glad to have all of you here today. Having mentioned that, without taking much time, let me now invite Dr. Nandalal Veerasinghe, Governor of Central Bank of Sri Lanka, to deliver opening remarks for this special lecture and also to introduce today's speaker to the audience.
Thank you. Good afternoon, Dr. Krishnamurthy Subramanian, Executive Director of the IMF, representing our constituent as well, including India, Sri Lanka, Bhutan, and Bangladesh, and also my colleagues, deputy governors, distinguished invitees, ladies and gentlemen. Today we are extremely privileged to have Dr. Krishnamurthy Subramanian to deliver a lecture on monetary policy in a changing world, a very timely topic for Sri Lanka as well as for many other countries, given the social, economic and political shocks witnessed across the globe at an unprecedented level and its implications for monetary policy making. For the last decade, also, we have experienced three unusually large crises in the world. Those are the global financial crisis due to excessive risk taken by the financial sector of advanced economies, the sovereign debt crisis that emerged in Europe, and the COVID-19 pandemic. Started as a health crisis but shortly developed into an economic crisis. During this crisis, the central banks around the world implemented different kinds of measures to stabilize their economies. Monetary policy has changed radically, especially since 2007 to 8 global financial crisis. The monetary policy toolbox today looks very different to what it was so a couple of decades back. Nowadays, most central banks work with several tools, some which are modern iterations of old approaches, both in times of crisis and in normal times. If the world changes, we need to change with it. Monetary policy and the way we conduct monetary policy must evolve with the circumstances. Moreover, the previous episodes of economic crisis remind us that the future is always uncertain and that preparedness for crisis needs to be central element of any monetary policy. Given the above, monetary policy in a changing world is an interesting and timely topic for all of us, those who are interested in central banking, and I am sure Dr. Subramanian will enlighten us more on the need for the evolution of monetary policy in line with global developments and challenge, which is in fact a very timely topic even for us now. But before that, let me formally introduce Dr. Subramanian, who is a leading expert in economic policy. Dr. Subramanian served as the 17th Chief Economic Advisor to the Government of India from 2018 to 2021, which is the most challenging period even in the Indian economy due to the pandemic. As the youngest Chief Economic Advisor to the Government of India, Dr. Subramanian instituted policies that led to India emerging from the COVID-19 pandemic with strong macroeconomic fundamentals. Being part of a major economic and corporate reforms in India, Dr. Subramanian has worked in expert committees for the Securities and Exchange Board of India and Reserve Bank of India. He has also worked with JP Morgan Chase, ICICI Bank, and Tata Consultancy Services. Dr. Subramanian has been appointed to the post of Executive Director at the International Monetary Fund in November last year, representing Bangladesh, as I mentioned earlier, Bangladesh, Bhutan, India, and Sri Lanka. He is our representative at the board, especially at this crucial time. We hope that he will be very supportive of Sri Lanka and represent our interests at the board at this crucial time. Furthermore, he is a professor on leave at the Indian School of Business. As the Chief Economic Advisor to the Government of India, Dr. Subramanian authored economic surveys on ethical wealth creation for a Prosperous India, that publication, I think, survey between 2019 and 20. The strategic blueprint for India to become $5 trillion economy, that was again a work in 2018-19, and the post-COVID economy using public capital expenditures in infrastructure and healthcare to further counter-cyclical fiscal policy during 2020 and 2021. Dr. Subramanian's research in banking, law and finance, innovation and economic growth, and corporate governance has been published in the world's leading journals. Dr. Subramanian is an alumnus of an Indian Institute of Technology, IIT, the famous top Indian the academic institutions in Kanpur. I studied, in fact, electrical engineering, and at the beginning he's a trained professional engineer, and later converted into an economics by doing a Master of Business Administration from Indian Institute of Management in Calcutta, and later he received a Doctor of Philosophy, PhD in Financial Economics from University of Chicago, Booth School of Business, where I understand the former RBI governor, Professor Raghuram Rajan, has worked with Professor Raghuram Rajan in his thesis, who also happened to deliver a couple of lectures here as a governor and also even before he became the governor. So without further ado, let me invite Dr. Subramanian to deliver his speech. Thank you very much.
Thank you very much, Governor. Esteemed dignitaries, including several of the governor's colleagues, governors themselves, and the esteemed audience. Let me first start out by thanking you all for providing me the opportunity to share my thoughts. This is based on a book that has just been released. The title of the book is Money, a Zero-Sum Game. We've had the privilege of a foreword on the book by the Honorable Finance Minister, Ms. Nirmala Sitharaman, and several luminaries, including former governors and current ministers in the Indian government, have been kind enough to read an early draft of the book and give some advance thoughts on the book, including Dr. C. Rangarajan, who, of course, was the RBI governor and also chairman of the Prime Minister's Economic Advisory Council, Dr. Arvind Panagaria, who worked as the vice chairman of Niti Aayog, the new version of the Planning Commission of India, current ministers, Railway Minister Ashwini Vaishnav ji and Piyush Goyal ji, and Indra Nui, the former chairperson and CEO of PepsiCo, and Dr. Rajiv Kumar, who also had been the vice chairman of the Niti Aayog. So I'm going to talk about this, just excerpts from the book. The book is available on Amazon. Hopefully, I'm able to develop some interest in the book among you, through this. So the title I chose for the talk of Monetary Policy in a Changing World, I think is apt because the ideas for this book started germinating in our minds, after the global financial crisis. So these ideas have been brewing since then, and of course, during COVID as well, we were able to think through, my co-author and I. This is co-authored with Professor Vaidyanathan, who incidentally happens to be my younger sibling, 2 years younger, who's also a professor at the Indian School of Business. So the key objective why we wrote the book is to develop a new framework for money. Now, the question that will arise is, what is the need for a new framework? One can, try and motivate the need for a new framework only if the existing framework is not working. So what is it that is not working, in the current framework? So if we start, and the governor very rightly mentioned as well, there's been a sea change in monetary policy tools since the global financial crisis. Following the global financial crisis, central banks across the world not just in India or Sri Lanka or emerging economies, but even in advanced economies, pulled out what many commentators have called them bazookas, heavy artillery, to try and stimulate economic growth. And a lot of the unconventional monetary policy, which has led to balance sheets of these central banks multiplying several times, are part of these monetary bazookas. And yet, economic research, generally economic research does not agree on a conclusion, but by far the conclusion, at least on some of this unconventional monetary policy, seems to be that it has failed to stimulate growth. If you look at in the advanced economies, on average growth post the global financial crisis is 1% lower than the than economic growth, than GDP growth pre-crisis. So clearly it seems like these monetary bazookas, and provocatively I will actually say that these are proved to be damn squibs. The question is why? Why is it that these have not worked? And our thesis in this book, and which thesis that we develop conceptually, but also provide empirical evidence using the using cutting-edge econometric methods, is that monetary policy that has been implemented derives from a monetary theory that is flawed. That's the essential thesis that we are advocating. So now, as Governor was mentioning, I started out as an engineer. I then have happened to come into economics. One of the maybe advantages or disadvantages of being an interloper in a profession is that you try and compare across professions. And when I compare some of the epistemology of natural sciences and engineering with economics, sometimes I wonder that while theories in natural sciences and in engineering are often developed to try and explain the real world, in other words, the theories start from the real world and then theories are constructed. The Newton's laws of motion, for instance, are a very good example of this. Oftentimes in economics, theories are actually constructed with assumptions like representative agent, who represents the preferences of all the people in the in the economy, rational profit maximizing, a utility profit maximizing firm, or utility maximizing consumer, and aspects which oftentimes are while many of us economists will try and defend those as abstractions, are also those that don't necessarily sit as well with the reality. And so, one of the things that I've always found is that, collectively economics has far more puzzles than all of the other disciplines put together, because the theories that are constructed and the predictions that come from those, when one takes it to the real world, oftentimes the predictions don't quite match with what we see in the real world, and that's then called a puzzle. In other words, the direction basically, instead of observing the real world and then constructing a theory, it is, the theories constructed, predictions are derived and then taken to the real world. And if it doesn't fit, instead of calling the theory wrong, the real world is basically called a puzzle. And that's why puzzles proliferate in economics far more than any other discipline. So I think that the spirit of what we are, we've done in this book is essentially captured by that. In fact, in the first economic survey that I wrote, what I've just mentioned is actually, it's part of actually the literature now, the economic survey. There's a box, very first box in the first economic survey I wrote had this, essentially showing how the epistemology in economics seems to be at variance with those in other disciplines. And I think as a result, oftentimes we get theory that does not necessarily help us to understand the world well, and thereby gives us predictions that also possibly don't work as well. So I think that's the the spirit with which we've basically have written this book. So combining our experiences as engineers, and especially one of the things that we learned is thinking ab initio, thinking from first principles without any color of ideology, without any color of prior assumptions, just starting from first principles, build up. Second, we both of us worked as bankers before we went and did a PhD, and so had actually seen how banking works in the real world, and that real world experience, we've then combined it with research, the research experience that we've had as academics. So the combination of engineering training with practical experience as bankers, together with the academic rigor that we've developed in being able to publish in the leading journals, I think is that we've combined that to write this book. So primarily what the book does is it highlights the flaws in the current monetary theory. I'll give you examples of some of those. And these flaws are not just, this is not a book that is written for India or for just the emerging economies. What we're talking about is equally applicable to the advanced world as well. So we highlights the flaws in the current monetary theory, and thereby then develop a new monetary theory, which helps us explain why the monetary bazookas were damp squibs, and then suggest policies that can be effective in the real world. I may not have time to go through all these four. I'll try and give you a sense of all these as much as possible. So what I'm going to hopefully cover, I'll be able to cover maybe the first three parts, not as much the fourth, but so I'm going to start by first showing you some real phenomena that monetary economics cannot explain, and then I'll try and give you a sense of the new framework for money that we have. How does that rationalize these puzzles? And then finally, what could be some of the new insights that we can obtain? That's in the third section. I will not have time to actually go into the power of the banking sector, but I think part of if there's one key message that we want to convey, through this book, it is that the banking sector collectively has far more power than the current literature has recognized, because they are the dominant creators of money in any economy, so in some sense we basically think about banks as money creators. Those of you who follow the economic research very closely, this year's Nobel Prize given to of course, Professor Doug Diamond, who I had the privilege of learning, financial intermediation from at the University of Chicago, and Ben Bernanke and Phil Dybvig. The Diamond Dybvig, is basically the canonical model of financial intermediation and bank runs that all of us learn when we during our PhD programs. But I think we do sort of raise questions about that particular view of banking. The view of banking that we advocate in this book is banks are money creators, not just financial intermediaries, and that's something which hopefully I'll try and give you color on. So let's start with some phenomena that monetary economics cannot explain. So one of and this is something we've all learned in our if there was an undergraduate class that we took in monetary economics, or even in graduate school, we are taught that the money multiplier, it's a very important concept in monetary economics. The money multiplier is basically captures the multiplication that happens through transactions, deposit and loan transactions, all through the through the monetary system. The monetary theory, current monetary theory, is basically says it's the reciprocal of the reserve ratio, and the reserve ratio essentially is the minimum a proportion of the liabilities of the bank that has to be kept with the central bank, and we all know why that is required, because banks essentially take liquid assets, liquid deposits actually, and convert them into illiquid loans, and therefore to make sure if there is people, a certain section of people want to withdraw their deposits, then this reserve is kept. Now, notice here in this theoretical prediction, there is no other variable that the theory predicts will explain the money multiplier. It is only the reciprocal of the reserve ratio. So now I'm going to, with that theory and that prediction, I'm going to take you through some of the actual evidence. Let's fit this to the real world. So let me start with the United States. So this chart here shows the multiplier, empirical money multiplier, which is the ratio of broad money to narrow money, in the United States. Notice here, so this is, I don't know whether the years are visible. The years are it starts from 2003 to 2013. So 5 years before the global financial crisis in 2008 to 5 years after. Notice that the multiplier was about, eight and a half, between 8.5 to 9 before the global financial crisis, and then declines precipitously after the global financial crisis, and continues to be between 2.5 to 3.5, during the period after the crisis. Now, what did the central bank, what did the Fed do during this time? Fed actually did not do anything in terms of the, in the reserve ratio. The reserve requirement remained constant at 10% all through this 10-year period. I think it is important for me to emphasize that. If it is the case that the reserve requirement was kept at 10% all through this 10-year period, then what monetary theory would tell us is that the money multiplier should have basically been the reciprocal of 10%, which is 10, and it should not have changed at all. So theory says there should be no change in the money multiplier, and yet what you find in the data is a drastic decline in the multiplier, which is not explained by the theory. That's the first piece of evidence. Let me start with the second. This happened during COVID. So Fed abolished the reserve requirement, 10% reserve requirement, on 26th of March 2020. So this was during the COVID period. So if it abolished, what does that mean? Your reserve requirement now is, for the US banks, it is zero. Essentially, it's completely abolished it. Now, if the reserve requirement has been brought down from 10% to zero, what should the theory then say? That the multiplier should have been 10 before and should go to infinity, after, because the reserve ratio has been brought down to zero. In other words, at the very least, the theory should tell us, theory tells us that the money multiplier should increase because the reserve ratio has been brought down from 10% to zero. What do you see in the real world? This is again the empirical multiplier shown from September of 2019 to September of 2021. So, 1 year period before and after. Again, you see that the money multiplier has basically, firstly, it was nowhere close to 10, before this change. And after the change, the money multiplier decreases instead of increasing. I mean, the theory would tell us basically that there should be an increase because the reserve ratio was decreased from 10% to zero. And yet what you see in the real world is, exactly opposite of what the theory predicts. That's a second piece of evidence, on this. In the book, we show this not just for the United States, but for each one of the OECD economies. Each one of those OECD economies, the evidence is there, and I refer you to those where the reserve ratio is not changing, or actually is changing in one direction. The prediction is basically that if the reserve ratio declines, multiplier should increase, and yet it does not happen at all. So across one after the other OECD economies, we show this. Then let's come to, I have some here. This is United Kingdom. No change in the reserve ratio. Multiplier is all over the place. Second, this is basically Australia and New Zealand. We have then Japan and Norway. Next, you have South Korea and Switzerland. Then you have Iceland and Denmark, and then Chile and Turkey, and Czech Republic and Israel. And in all of these, actually, the money multiplier, as you can see, is all over the place. Without much change in the reserve ratio at all. So it's not just for the United States, but for each one of these OECD economies, this theory that the money multiplier is a reciprocal of the the reserve ratio is not working. And this is really critical. It's very important because a lot of conventional monetary policy that is done by central banks is based on the theory of the money multiplier. Why? Why did central banks cut the reserve ratio during times of let's say when the economy is not doing very well? The idea there is that monetary base times the money multiplier is basically the broad money in the economy. We can think about M0 as or M1 as the as the monetary base. Because this is a central banking crowd, I'm actually not going to go and explain what M0 and M1, etc. are. So I'm going to presume in the interest of time. So let's take the monetary base as M0 or M1, M3 as the broad money in the economy. So monetary base times the money multiplier is equal to the money supply in the economy. The idea is, even if the monetary base itself does not change, if you increase the money multiplier, you will actually increase the supply of money in the economy, and that is why central banks cut the reserve ratio to try and increase the money multiplier. But what has happened actually is, even though central banks have cut the reserve ratio, multiplier has not increased. So one key pillar of conventional monetary policy does not seem to be working, and that is something which is important for us to ponder. One as those that have interest in monetary policy, but also as those that actually think about monetary theory itself that leads to this prediction. I'll also give, because this is a country that I'm from and I track very closely, from India. So before the global financial crisis, in India, the reserve ratio was 9%, and the Reserve Bank of India decreased the cash reserve ratio from 9% to 5%. Again, what should you expect? From 9% to 5%. If the theory is right, when the cash reserve ratio is 9%, the money multiplier should be the reciprocal of 9%, which is 11.1. So multiplier should be 11. When the reserve ratio is decreased to 5%, reciprocal of 5% is 20, and therefore the multiplier should basically go from 11 to 20. Actually, what happened was the multiplier just remained range bound between 4 and 5. It was not close to 11. When the reserve ratio was 9%, it was nowhere close to 20. In fact, it basically remained range bound. In other words, theory tells you that this decline in the reserve ratio. And why did the Reserve Bank cut the reserve ratio? Hoping that the money multiplier would actually increase, but that did not happen at all. And so clearly, the real world seems to be actually dancing to a completely different tune to what monetary theory tells us. Similarly, during the COVID crisis, again, from 5%, which was basically, as I said, after it was brought down to 5% during the global financial crisis, it continued to be at 5%. Then the Reserve Bank cut the CRR during COVID, again, another crisis, from 5% to 3%. Again, what should have happened? The reserve ratio is cut, multiplier should have gone up. That's what theory tells us. I think simple theory. But what happened in reality? The money multiplier actually decreased, not increased, decreased from 7 to 5 in 2021. Again, clearly, what is happening in the real world is completely at dissonance to what the theory tells us. So that's the first set of, which basically we kept looking at these, ever since the global financial crisis, we've been looking at these multipliers and say, something doesn't seem to be working for sure. It's not, this is really, theory is not really working in terms of, a second key, and this is what has, the governor mentioned this is a second premise that has driven a lot of unconventional monetary policy, especially in the, in the central banks of the advanced economies, QE, quantitative easing. One of the key premises that has basically, driven unconventional monetary policy is that if you essentially give more bank reserves to banks. In other words, relax the constraints that there might be on bank reserves. If banks have more reserves, they will go and lend more. In other words, bank reserves and lending, bank loans can actually substitute for each other. So what has, as part of QE, what has the Fed, for instance, done? Bought a ton of MBS, mortgage-backed securities from the private sector, and the Fed's balance sheet has increased 7 to 8 times. In fact, if you look specifically here and look at the chart on the left, the chart on the left shows from, again, the same 10-year period during the global financial crisis, the reserves of the commercial banks, in the US. So notice that the bank reserves were, you can see the line seems to be almost close to zero, in the up until 2008, because the bank reserves were only 14.9 million. The axis here actually on the left panel, the axis is in $1 billion. So clearly, the reserves before the global financial crisis is minimal, 14.9 million. After the crisis, as you can see, in 2013, the reserves have increased to $2.5 billion. So that's a multiplication of 167 times in the bank reserves, from from $15 million to almost to 2.5 billion, almost a 167 times multiplication in the reserves. If the theory were right, that should actually show up in bank lending, right? That's what should show up in bank lending. The fact that reserves have been released, so much bank reserves has been released, bank lending should have actually grown. Now look at the chart on the right. The chart on the right shows what you see as shaded bars. Those gray shaded bars is the actual lending that happened in the US, actual lending. And notice here, so there is actually a decline in the actual lending after the global financial crisis. If we compare with the trend that should have prevailed, and the bars with the white portion in it and that trend line shows this is what the trend should have been. If the trend had continued, then actual lending should have been what is being shown up until the white bar. So compared to that trend, actually bank lending declined even more. So counterfactually, in other words, compared to what the trend should have been, bank lending has declined even more. Again, one of the key premises of monetary theory, that releasing bank reserves should actually lead to lending, that has not worked in actual numbers, because actual lending has gone down. Not just that, compared to the trend that prevailed, which is the right way to compare. All of us, here, understand economics, that we should be comparing with the trend that prevailed. When you compare to that, actually the decline is even more. So again, another key, a fundamental premise of monetary theory does not seem to be working in the real world. And why did, if we ask the question, why did central banks want to stimulate bank lending? Because they wanted growth through bank lending. We know very well, when bank lending goes, basically bank lending is done to good projects, that leads to output creation in the economy. But that has not happened. That is why if you look at research, there's, a lot of research now, it's been almost, close to 15 years after the global financial crisis, which looks at the economic impact, the growth impact of these, the QE programs and the unconventional monetary policy. And, most studies seem to find not much impact on, even those that find the impact is actually very, very marginal. Now, if you're talking about almost 170 times multiplication in bank reserves and a 7-8 times multiplication in the Fed's balance sheet, then the impacts of that, basically these are bazookas. This is heavy artillery that's been pulled out, and the impact on growth is basically either non-existent or is marginal. Question that needs to be asked is clearly, what is happening in the real world is not consistent with what monetary theory is telling us, and therefore the monetary policy that is being driven based on this theory. It's as if, let me give you a parallel. Because this is something most of us understand. If suppose, let's say, medical theory comes up, and based on whatever research they do, they come with a prediction that if you have a viral fever, antibiotics should be given. If that's the theory that researchers in medicine advocate, what will doctors do? Doctors are the implementers of that theory. They will prescribe antibiotics when a person has viral fever, or and now the patient will not improve because that is not the right prescription. But either of two things, either or maybe and two things are happening. Doctors themselves actually, in their pride in their profession, they're not acknowledging that the patient is not improving. And because they're not possibly acknowledging that the patient is not improving, they're not communicating back to the researchers that whatever prediction that you're coming up with, your theory is wrong. That antibiotics should not be given when you have viral fever. That, to me, in some sense, captures basically monetary theory and the monetary policy that is being driven by monetary theory. The patient, which is actually the economy, has not recovered. So I think this is the the key aspect that I wanted to. I mean, if you look at, again, in India, I gave you evidence for the US. If you look at for India, these are actual statements. Around this time, global financial crisis, the finance minister then kept lamenting about the fact that banks are not lending, and is an actual quote from, he says, despite the loosening of CRR limits. CRR is basically what? That's a reserve ratio. When you loosen the reserve limits, what happens? Bank reserves get released, which is basically that's the theoretical prediction that lending should have gone up. And he says, credit creation continues to be elusive. Bank credit has been steadily declining. And in fact, if one goes and reads the economic media in India, this word lazy banking, every, commentator seems to talk about on the premise that, oh, look, banks are sitting on so much reserves, bank reserves, they're not lending, lazy banking. But what we are highlighting is that it is coming from a premise that is, that is not doesn't seem to clearly work. So this is a key part of basically what is not working in the real world. Now let me get on to, so I've basically picked holes in the current monetary theory. Now I'm going to transition into what is it that we are actually talking about. So at this point, I should take a couple of minutes to explain, the key premise of some of the, let's take the theory of financial intermediation. The theory of financial intermediation, which is basically what, banks are viewed as financial intermediaries. What does that theory say? It says that banks take deposits. These are essentially liquid deposits because the depositor can come and claim that deposit at any point in time. He may come and deposit it just now and claim it the next instant. And they convert it into illiquid loans because these loans are 5-year maturities, 10-year maturities. So it's as if basically a parcel of liquid, think about it as liquid milk, parcel of liquid milk is being taken, converted into illiquid ice, but passed over. Some transformation, maturity transformation, liquidity transformation happening, but it's still as a passing of the parcel, taking deposits. The intermediary is just basically passing it on as loans. So that's what an intermediary effectively is, right? If you think about a FedEx, FedEx is an intermediary essentially between those that have to send some parcel and those that have to receive a parcel. They're actually passing the parcel. Now, this theory views banks as intermediaries and thereby, in fact, does not make a distinction between banks and non-banking finance companies. For instance, the NBFC is doing the same thing as well. The non-bank finance company takes a loan from the bank and gives it to their lenders. So in the theory of financial intermediation, for instance, there is no distinction between banks and NBFCs. But here's where we put this theory to test using very careful. Those of you who work in econometrics, would and the Nobel Prize last year was given to Angus Pischke and his co-authors for some of these, some of the cutting-edge econometrics, what is called the regression discontinuity. This is called the RDIT design, which is there's a discontinuity or a natural experiment. So the demonetization in India, we use that as an experiment. What's the advantage? During demonetization, it was only a 2-month exercise. 2 months where the deposits increased significantly. In fact, deposits increased by 8.5 lakh crores. Now, if the theory of financial intermediation is right, what should have happened? You've taken a parcel of 8.5 lakh crores additional deposits. That should have actually led to greater lending. That's what the theory of financial intermediation, essentially the prediction is that deposits lead to loans. Now, if that prediction were true, an 8.5 lakh crore increase in deposits should have led to some increase in lending at least. Now, the advantage of this natural experiment is that nothing else is essentially going on. In a small 2-month period, GDP growth did not get impacted that much. So it's a nice natural experiment where confounding factors, which all of us who do research in empirical research worry about, that there may be other things that are going on. That's not happening. And what do you see here? Look at the chart. So on the left side is basically the chart on deposits, and on the right side is the chart on lending. Here again, I'm showing you the actual lending and the lending compared to the trend that should have obtained. So deposits increased by 8.5 lakh crores during this time, and lending actually declined by 1 lakh crore. Again, the key premise, theory of financial intermediation, which is what is a bedrock of the theory of the monetary theory, is not working. Some of you will actually, will be thinking here, oh, what gall, going and challenging Nobel Prize winning work, that I'm sure some of you may be thinking. But one of the things I learned when I did my when PhD at the University of Chicago, I was told is that every research is work in progress. Every research is work in progress. It may be that the Nobel Prize winning research is actually higher quality work in progress, but it still is work in progress. And when you have actually evidence that challenges that, I think it has to be, research has to go by not the person that basically, who's advocating the theory, but the actual, the content of the theory. The content of the theory is that deposits lead to loans. That does not seem to be happening in reality. So clearly something is wrong here. So I'll just quickly summarize and then give you a sense of the theory itself. So money multiplier, as postulated by monetary theory, is dismally fails to explain what we observe in the real world. Increasing bank reserves does not seem to be leading to more bank lending. Monetary policy efforts by central banks, so-called monetary bazookas, post the global financial crisis and, during COVID do not seem to have worked. Deposits do not cause loans as predicted by the theory of financial intermediation. So what is it that we basically, what's the framework that we offer? And that will also allow me to explain why the title Money as a Zero-Sum Game. Let me, without getting into the slides, just intuitively explain the key aspects of. So think about how, I'm sure many of you have gone and borrowed loans from banks, right? What happens when we approach a bank? So suppose I approach the Bank of Ceylon here for a loan of 100,000, Sri Lankan rupees, let's say. Will the lending division there first go and check whether we have deposits? No. They're going to basically first, what they're going to do is they will assess my credit. They'll look at whether I have the ability to repay, whether I have the willingness to repay. And if they're convinced that I have both, I have the ability to repay and the willingness to repay, they will sanction me that loan. And when the loan gets disbursed, what happens when the loan gets disbursed? My bank account actually gets credited to the amount of 100,000 Sri Lankan rupees. So I asked for a loan of 100,000 rupees, and what has that done? It has basically gotten credited in my bank account as 100,000 rupees in deposits. Now think about what does this do to the balance sheet of Bank of Ceylon. Now compared to earlier, both the assets and the liabilities part of the Central Bank of Ceylon's balance sheet have increased by 100,000. Why? Because the asset, which is the loan that is given, to me, is an asset for the bank. It's a liability for me. The asset has increased by 100,000, and because the deposits of Bank of Ceylon are essentially a liability for them, they have actually, that have increased by 1 lakh as well. So effectively, what has happened? There is the balance sheet size of the Bank of Ceylon has increased by 100,000. In this case, it is the activity of lending, the lending of 100,000. That is what has actually led to deposits increasing by 100,000. That's the first premise, and we actually provide evidence of that. This is where our practical experience as bankers comes in, thinking about how does it actually work. Money gets credited, and deposits. Now, the second key part, when we think about the broad money in the economy, when we think about the broad money, what is it comprised of? It is comprised of basically the currency in circulation, together with the, with bank deposits. Now, in almost all economies, India, advanced economies, etc., the proportion of deposits in broad money is almost 90%. So if we take the broad money supply in the economy, 90% of that is, and these are empirical facts, almost between 85 to 90% is just deposits. So who is basically creating, and who's creating that deposit? Where is it coming from? It's coming from the banks. As I just explained, when they give a loan, that's when deposits go up. And who's doing that? It's not the central bank that is doing it. It is basically the banking sector that is doing it. So 90% of money creation is essentially happening through banks. And that is the key point to understand, that money creation, broad money creation, significant part of it essentially happens by loans being given. And this is, some of the recent literature, talks about this as well, that banks create money ex nihilo. Ex nihilo. And by the way, I must tell you actually that these ideas, if you go and read Joseph Schumpeter, You go and read Milton Friedman, and in the book we actually have a review of the literature so this idea of banks as money creators has existed since the 1930s. It's only since the 1960s, 70s, when the theory of financial intermediation theory started coming in, that this notion of banks as money creators was abandoned, and all that we have today actually is thinking about banks as intermediaries. So what we've actually done is, gone back to an earlier literature, and stalwarts like, even James Tobin, one of the other Nobel laureates, Schumpeter, Tobin, Milton Friedman, all of them actually talk about the fact that banks are money creators. They create money ex nihilo, it helps the fact that, banks, have to practice fractional banking, which means that if they actually create deposits of 100 rupees, they don't have to keep the entire money as reserves, right? So I want to spend a couple of minutes explaining why this may be sometimes counterintuitive. The theory of financial intermediation actually thinks about lending much like a money lender would do. How does a money lender give loans? Money lender cannot lend money that he does not have, right? Or for that matter, if let's say, if I am in trouble and I ask the governor for a loan of 1 lakh, or 100,000, he cannot give me that loan unless he has the 100,000. That is key. That is how it works with individuals. But banks are different from individuals. Banks basically create money ex nihilo. And that is why from lending, deposit creation happens, and the bulk of money creation in the economy is done by banks. This is something that is extremely critical to understand. So the fundamental flaw, as I said, is that it creates banks as financial intermediaries. Paul Krugman, for instance, writing in the New York Times, about the Nobel Prize in Economics, says banking is any form of financial intermediation. And as I just explained, that is how banks are being, are viewed over the last 35, 40, 50 years. But we demonstrate that banks are money creators, not mere financial intermediaries. And we lay the conceptual ground for this thesis and provide rigorous evidence to support the thesis as well. So I'll with this slide, I'll stop, and then what we provide, banks are money creators. The first thing is, the concept is when bank gives a loan of rupees X, let's say, it credits the borrower's account of that amount. Because of fractional banking, deposits do not constrain loans. So a deposit of 100 can actually mean, if for instance the reserve ratio is, let's say, 4%, loans up to 2,500 can actually be given from just deposits of 100. Because think about it, 2,500 times 4% is 100. So that initial deposit that came in at 100 can be used to keep as reserves of 100, and loans can be given up to 2,500. So if banks give a loans up to let's say 2,500, 4% of that is 100. They can actually keep 100 reserves, and definitely keep lending up till that point. Together with the evidence from demonetization, we show essentially that banks are money creators. As I just mentioned, deposits account for 90% of the broad money in the economy. This has a lot of predictions. So let me spend time on just one key aspect of. So if we think about reason some of these bazookas fail, we think about monetary base times the money multiplier is equal to the broad money. That's what you see in the blue. That's what monetary theory is. But actual monetary policy, therefore, derives from these two, which is that either you increase the monetary base or you increase the money multiplier to increase the broad money in the economy. What we are actually showing is that neither of the two, which is increasing the monetary base by, for instance, enhancing bank reserves, nor increasing the money multiplier through the reserve ratio, neither of those work. So the question that may come into many of you is, I'm here, in central bank premises, basically telling that the two key tools that central banks can use do not work. So the question that will come is, what is it that you're telling us that we can do? I think, and that's where I want to spend a couple of minutes. The key role of central banks is essentially, as banking sector regulators and banking sector supervisors. I think that is because, as I just mentioned, banks are the money creators. 90% of money creation in the economy happens through banks. And in banks, the growth of balance sheet or growth of lending is like the accelerator. The credit risk function, risk management function is like the brake. When the accelerator and the brake actually work in a finely tuned manner, both lending and actually the evaluation of credit risk, both of those work very well. The car moves very smoothly. So one of the key parts of central banks is to ensure that the accelerator and the brake are finely tuned, that there are incentives for basically the banks to evaluate credit risk properly, make sure that some of the crony lending that happens in our parts of the world, those are, what is crony lending? It is basically lending to dubious projects, which will basically, because the lending happens, money creation does go up, but output does not get created because it's been lent to bad projects. So, these are the aspects that need to really be focused on. In other words, the role of the central bank as the regulator of banks and as the supervisor of banks, I think, is far more important than the traditional monetary policy, which is actually setting the policy rate or changing things like the reserve ratio. This is far more important because I'm sure many of you are also aware there is a large literature on monetary policy transmission itself, that even though the policy rate, let's say, gets changed, the actual lending rates do not often respond to that. So, which is also another aspect of of monetary policy that needs to be thought about. So broadly, I want to essentially highlight that the ways in which conventional and unconventional monetary policy is thought about, using the concept of the money multiplier or using the concept that releasing bank reserves will actually lead to lending. Neither of those really work, and that is why what we see is that these bazookas that have been pulled out have really not had much impact on on growth in the real world or even lending, bank lending, in these countries. So I had several more slides, but in the interest of time, I'll just and maybe 30 seconds. This is one of our key contributions in the book. We come up with an equation that we actually, in some arrogance, I must say, we've named it after ourselves, the Vaidya-Subbu equation, VS equation of money supply, which has all the determinants, anything that affects money supply, and we derive it rigorously, in the book. Anything that affects money supply is in here. Anything that does not affect money supply cannot be in here, and that's something which is quite important. So let me stop. In some theory, our book develops a new framework for money, thinking about money as a zero-sum game. And this, I think, I forgot to mention this. Why is money a zero-sum game? I'll end with that. When you think about the three kinds of money that prevails in any economy, there are only three kinds of money. One is the currency that you carry in your pockets, in your wallets, right? When you think about that, what is it? It is an IOU, because after the Bretton Woods, there is no gold standard, so it is actually just an IOU. And in Sri Lanka here, it is essentially signed by the governor, and it is essentially in our pockets, right? So it's a liability for the central bank, an asset for the for the person holding it. So if it is a 1,000 rupee note, it's a 1,000 rupee liability for the central bank, 1,000 rupee asset for the person who has it in his pocket. Equal asset, equal liability. The second form of money that prevails is bank deposits. So if I have 100,000 bank deposits in my bank, that is an asset for me. It's a liability for the Bank of Ceylon, for instance. Again, an IOU, equal asset, equal liability. And the third form of money that prevails is bank reserves. So Bank of Ceylon keeps reserves with the central bank. That is essentially a liability for the central bank, asset for the for the commercial bank. So if you think about each one of these three forms of money, it is an IOU, and like the Newton's third law of motion, and every action has an equal and opposite reaction. The action of creating that 1,000 rupee note by the governor when he signs it, that action creates an equal, which is 1,000 rupee, and opposite, which are, it's a liability for the central bank, asset for the person holding. So equal and opposite liability for the person who's basically holding the other part of the IOU. Same way with deposits, same way with bank reserves as well. Now, when you aggregate all these at the macroeconomic level, every asset, every liability eventually cancels out. It's a zero sum, essentially, because equal and opposite. And this is the difference between money, which is a financial asset, versus a physical asset. If we take a physical asset, difference between a home and a home loan, or a house and a housing loan. A house is an asset for those of you who have houses, but it is not a liability for anybody else. It doesn't have the feature of creating an equal and opposite liability. But a housing loan is essentially a liability for those who take the housing loan. It's an asset for the bank that essentially gives it. So this is a big difference between money versus other assets. Money is essentially an IOU, and therefore at the macro level, it is a zero-sum game. And I think that zero-sum game, the way it is played, who is the loser, who is the winner, matters a lot for the real economy. And that is why it is important to think about money, because it affects everyday lives in a very, very material manner. I'll stop there. Thank you very much.
Thank you very much for that insightful speech with a sort of a different perspective, I guess. With that, we will be concluding the virtual session of this program. Thank you very much for those who joined with us online. However, we are happy to accommodate few questions from the audience here. So if you have any questions, you can of course table those right now. So may I invite Governor to open the floor for questions, sir.
Thank you, Professor. Very interesting the idea and basically the theory that you presented. As far as my understanding, what you argue here is the creation of money in a system is, if I understood correctly, is more to do with the regulation and supervision part more than the creation of money through the money multiplier. So that you stop that point. And then I'm thinking about when it comes to monetary policy implementation, how does that basically work? For example, now you look at this and money creation and overall stock of money and how that happens in a different mechanism, not through the money creation, money multiplier, but through the banking channel. So, I mean, for central bankers, the practical issue is that we have dual roles. It's one from stability, regulation, supervision, otherwise the monetary policy. Yes. So in an first question, in an institution arrangement where when you take the FSA is separate from the other, they basically what you say is FSA has a much more important role in creation of money than the real monetary policy of the central bank. But there are two different objectives. So I think what you I didn't talk about is beyond that when it comes to our key objective, system stability versus inflation objective. Yep. So obviously what we all know, monetary policy transmission from a monetary policy inflation objective is there are several channels. It's only one is this channel that you are talking about. There are several channels that could have an impact on the inflation or output gap on one hand. But what is your expectation beyond this, say money creation can lead to either growth or inflation or something like that? Yeah. So then you didn't talk about that. Do you have any ideas of what is the process next on one system stability side, other one from the inflation side?
Yeah. Thanks a lot, Governor. I think that's a very good question. So let me maybe, I was not able to explain fully. So this is not one part of money creation. This is the entire of money creation in the economy. Why? Because as I showed, when we take the overall money supply in the economy, take it as M3. M3 is essentially your deposits plus the plus the currency in circulation, right? Or if you think about what the central bank controls is directly controls is the monetary base, which is including the bank reserves and the currency in circulation. The central bank indirectly controls the money supply in the economy by either changing the monetary base or affecting the money multiplier. Now, in the money multiplier is where the monetary policy transmission is really embedded in. Because, for instance, suppose you change the policy rate, and the policy rate is a short-term rate. When we think about the yield curve that prevails, you are really impacting the short-term rate. Now, that short-term rate, first actually banks have to change their short-term rates. Based on that, how much they decide to change some of the long-term rates on their lending, that is what affects the monetary policy transmission, really. And eventually, it affects the lending that is being done by the banks, and thereby deposit creation in the economy, and thereby money supply in the economy. So I think this is important to understand that you are, in other words, the central bank, like the 9 pins that when we play that game of 9 pins, you're rolling the ball you're rolling is the policy rate. The first pin that you're trying to actually make it fall is the short-term rate, for banks. Then through that, the yield curve itself for the banks. That's a second pin. Through the yield curve for the banks, then the actual lending by the banks. That's a third pin. And through that, then, because lending is what creates deposits, through that, the money creation in the economy. So when we think about inflation and output, the what is called the quantity theory of money, Milton Friedman, essentially framed it, is how we, conceptually, and that part is right. That theory is right. The fact that essentially you have, the price times velocity of money is equal to essentially the overall output. So PV is equal to MY. That part is actually is right. So if you have too much money creation, but output does not improve at all, that can happen through, let's say, bad lending by banks, right? Bank lending. So if I basically, as a bank, let's say I end up giving a loan to a dubious company. Because I've given a loan, I've credited that much amount to the bank account. That has led to deposit creation, thereby money creation in the economy. Money supply has gone up. But if it does not lead to output, what you'll have is a lot of money chasing too few output, and that is why that's what we call as demand. Basically, the demand supply mismatch, and you get inflation. So what I'm trying to convey, and hopefully I have conveyed at least partially, and I'd humbly request you to read the book. We'll actually get a full sense of this idea. I think I must emphasize that this is not a mechanism of money creation. This comprises all the ways in which money creation happens in the economy, thereby inflation and output in the economy. So now to get back to the first part of your question, which is the twin roles that the central bank plays, one as on the financial stability part, and second on the price stability. Price stability is, of course, through inflation. The financial stability is through essentially the banks. So the first function of price stability is the traditional monetary policy function of the central bank. The financial stability is essentially your role as banking regulators and banking supervisors. And what I am trying to actually emphasize here is that traditionally the emphasis has been on the first role, on the price stability, but it is equally important to think about the central role, the second role, which is as essentially, on the financial stability part for price stability too. That is the key idea that I want to emphasize, that if your banks are not, let's say, in good position, they're not lending, then at a time when you want to, let's say, increase money supply in the economy and thereby maybe increase output and affect inflation as well, that will not happen very well without the second function fulfilling very well. In other words, bottom line, the emphasis on, in the twin roles, the second role is actually far, far more important than it has been, paid attention to. The first role is less important than it has been given attention to.
Sunil, thank you. I'll take one more question and then open up one is one of the what you show in the US huge quantitative easing, and that has not translated into the money growth in money as well as output. I think one of the arguments basically, one is that the huge, without that, what is the counter argument that if that did not happen, what would have been the expansion, or what would have been the impact on the economy probably? And also one of the reasons people talk about is this huge easing of expansion of balance sheet. Country like US has a spillover effects, and that basically had an impact on other markets rather than in the US as an open reserve currency. I mean, do you think that it has a role to play? I mean, did that play a role?
I think that's a very sharp question as well. These studies that I referred to, which have examined the impact of quantitative easing and unconventional monetary policies on economic growth, they actually do take, they build the counterfactual. Because, in research, if you have to show the causal effect of something, one has to look at the factual vis-a-vis the counterfactual. So I think your observation is absolutely correct, but what I will say is that even compared to the counterfactual, which is without this quantitative easing, without the 7-8 times multiplication of the balance sheet, what would have been the growth? Compared to that counterfactual itself, a lot of research does not find impact on growth, and that's the bottom line, that which is what makes these really question whether causal impact of basically the unconventional monetary policy on growth, what has it been? It's not your second question, I think, is here it is less about what you're essentially talking about is the fact that the expansion by the Federal Reserve itself, has had an impact on other economies. And for instance, in India, when the Fed announced that it basically is going to, sort of stop some of the quantitative easing, that had an impact on in 2013, which is called the taper tantrum. That when it's basically going to start tapering the now, this happens because in many of these markets, the macro fundamentals were not very strong. And the basic fear really was that there'll be capital flight. And as if you see, for instance, even during the Ukraine, after the Ukraine war, the reason the dollar appreciated against all other currencies is the combination of two phenomena, which is one is the flight to safety, flight into safe assets, with the U.S. Treasuries being those considered as safe assets, together with what is called the home bias. All of us feel comfortable at home, and American investors feel more comfortable, and so it is not because of that part is not because of the money creation bit, because this is basically money creation or absence of money creation in the US as much money creation, which then makes investors, American investors in particular, pull money out from emerging markets. When they pull money out from emerging markets, that leads to actually these markets, the forex markets, the fixed income markets, and the equity markets suffering, and that is what affects. So these are the externalities that are being created, in these emerging economies through the Feds, sort of deciding to clamp down on some of the money supply in the economy.
Thank you. Then I'll open up for one or two questions if audience has here, please.
Yeah. You had a graph on the US economy where you show credit was higher before the global financial crisis, and then it became lower. But there was a credit bubble related to the real estate sector having grown much more than it should have. So wouldn't you say that the credit level came to a more sustainable level post-crisis? And the second comment I have is about what the governor said. The US is a player in the global economy, and some of the money that was created went all over the world. So can you make observations about the US economy alone when it comes to money supply in the US and reserve money? Yeah,
so I think the second question, what in response to the governor's question, what I said was, when US, let's say the Fed is embarking on policy that reduces money supply, dollar money supply, what that does is that actually changes the behavior of American investors, and thereby impacts, the emerging economies, because they pull out money from these emerging economies and go back into this. It's a combination of, as I said, the flight to safety with the with home bias. That's how the externality essentially gets transmitted. And I think if you have other things in mind, maybe you can send me an email. We can talk about on the second part, because I thought what you said is something that I already answered. On your first question, again, I think that's a good observation. Clearly, there was the bubble was, so, 2-3 responses. One, the bubble was far more in the in securitization, less on the actual, the bread and butter lending. That was the first thing. So it's, a lot of yes, the subprime lending actually happened, because of securitization, some spillover effects for sure. But if you looked at the chart, what you see is that, the right way to compare, as the governor was rightly saying, is compared to the counterfactual. What would have been if, for instance, let's say the global financial crisis had not happened, there would have been, even allowing for, let's say, the bubble, let's say, got burst, the slope was a certain, like a 30-degree line, right? And when you extend that line, if the bubble, let's say, impact of the bubble, instead of 30 degrees, it might have grown at, let's say, at 15 degrees or maybe 10 degrees. But even compared to that, the actual lending is significantly lower. So, when you look at the impact of the global financial crisis, even accounting for the counterfactual and the fact that there was some bubble clearly suggests that lending firstly actually decreased, and compared to the counterfactual decreased significantly more. So the basic point that we are actually, what I'm trying to say is that the objective of that chart is not to explain why bank lending went down. That's not the point. The point we are trying to say is, if, for instance, bank reserves increased by 170 times, now, even allowing for the credit bubble having basically gone down, bursted, allowing for, let's say, the counterfactual trend as well, what we're saying, if there's a 167 or 170 times increase in the bank reserves, at least maybe 2 times increase, or maybe forget 2 times, a 20% increase in bank lending should have happened. I mean, where is 170 times, which is basically, it's 17,000%. So 17,000% increase in bank reserves should have at least had a 10% increase on even allowing for all of the credit bubble, the, counterfactual, etc. But actually what has happened is bank lending has gone down. That cannot be that much, look at the relative magnitudes. There is no way that the theory that, increasing bank reserves will lead to increased bank lending can be right with this kind of numbers that we're talking about.
Yeah, thank you. Thank you for such insightful presentation with a different perspective. But one thing, your theory, money is a zero-sum game. It is good for an economy, but as you said, when a bank lends, then that money gets deposited into a bank, and if it is in the economy, then it translates to deposit in other banks also. But what about when some capital works in progress, some import is made by customer, and money flows out of the country, and assets get created out of import? So then how it can be the zero-sum game and at that scenario?
No, so that, this is something that we consider, we really talk about. So for instance, if not just imports, foreign inflows that happen, it could be foreign portfolio inflows, it could be foreign direct inflows, money that comes in. Eventually what happens, suppose, let's say, let me take an example of, let's say, a remittance, because all these are actually, whether it's FDI, FPI, remittances, or foreign exchange, let's say import transactions. How do they work? They eventually get transmitted through the banking system, right? For instance, suppose, let's say, I get a remittance. I'm using the example of remittance because it's there in the book. Suppose, I get a remittance from, let's say, my relative, let's say in the United States. What happens? I suppose it's $1,000 remittance. I go and deposit it with my bank, ICICI Bank, and then in return I get essentially, let's say, 80,000 rupees as. Now, what does the bank do? The bank basically goes to the central bank, and the central bank is then clears it, and there's a change in the forex reserves, right? So eventually the clearing institution for all the banks is the central bank. So we do take into account all these, those monies that come through, let's say, whether it is in the form of FPI, FDI, remittances, or import-export transactions. Those will eventually have to be cleared through the central bank. So the way we derive this money supply, the equation, VS equation that I showed you, is by first having the balance sheet for the entire banking sector, and a balance sheet for the central bank itself, and combining both, and thereby, which is why I said actually it's not an empty claim. That equation has everything that can actually affect money supply in the economy. If a variable is not there in that equation, it cannot affect money supply, and I actually say it with absolute confidence, because we've checked that, a zillion times.
Thank you, Professor Subramanian. I have a more fundamental question about fractional reserve banking. Assume that there's a world without banks and it's all driven by technology, and you have peer-to-peer transactions, complete disintermediation. How should you think about this then? That the debit and the credit that creates the loan and the deposit does not exist through an institutional mechanism. It's all, I lend you, you invest, I spend. How should I think through this, and how will money creation in that kind of world work?
That's a good question. So in that kind of world, it is essentially all peer-to-peer. There are no banks, and banks are not having the central bank as a lender of last resort, as essentially the clearing house essentially for all the transactions. So in this case, if in an economy, this is effectively like a barter economy, right? It's just that the barter is not happening, I'm not bartering my rice for your, for your vegetables. Instead, I'm basically just bartering my money for your money. That is all that is. So this is essentially just passing the parcel. So let's say if it is a peer-to-peer lending, I start by first borrowing from the governor, he does a peer-to-peer loan, and then I, let's say, lend it to Chandranath, and then he lends it to you. It is essentially what is happening is the parcel is getting passed. Now, in an economy like this, there wouldn't be enough money creation at all in the economy, and therefore, if, for instance, if suppose you have a very good project, it's a fantastic project for which you need money, you want to go and invest money, and suppose you can't find enough, peer-to-peer lenders who will give you that money, then that project will not get done at all. And so, the output creation that will happen as a result of you doing that project will not happen either. And so, now from this, and I think it's a very nice, sort of a counterfactual to think about, compared to that, and that's why I think, in some sense, the key role that banks play in the economy gets illustrated by thinking about the way you are thinking, which is because banks are money creators, when they see a good project, they actually lend to that project, and by lending to that project, they basically, and that shows up as increase in deposits. That's what happens now. But then, suppose that project is a 5-year project. The output comes out of it at the end of 5 years. The output, when the output increases, then, if it's a good project, output will go up. What will the central bank do to make sure that inflation does not go up? Central bank will try to, increase overall money supply, and banking sector also, because banking sector will, responds to overall demand conditions in the economy. If output has gone up, lending will go up. Again, lending going up will basically increase money supply. So you'll actually have that when lending, happens to good projects in the economy, you actually go, there's a nice virtuous cycle that gets built up. But and it works exactly the reverse as well. If, for instance, on the other hand, and the Indian experience of crony lending up until 2014, and the overhang from that is a good lesson here. If suppose lending happens to bad promoters, dubious promoters, today let's say that maybe 1,000 crores of loans have been given, money supply went up by 1,000 crores, but that 1,000 crores basically was not put in any project at all, did not lead to any output creation. You have a money supply increasing by 1,000 crores, and if you take in aggregate 8 lakh crores of, let's say, bad, or 8 trillion rupees of bad lending, so money supply goes up by that much amount, but it does not create enough output in the economy. So, you have essentially, and using the quantity theory of money, if you think about it, you will have, that is also a contributor to inflation, because you have that much money now chasing assets that have not been created, output that has not been created, and that is another channel through which inflation, apart from, of course, in this particular period, the fiscal expansion, significant fiscal expansion in the Indian case also contributed to inflation, but this is another driver of inflation. So I think I like the way you actually framed it, but bottom line, in a peer-to-peer lending, economy, it's like, and let me use one more parallel to, when we think about NBFCs, for instance, right? That's a big difference between NBFCs and banks. NBFCs are actually are borrowing from banks and they're actually lending to their borrowers. They are not creating money. Banks are.
So, thank you for illustrating that, but it will be interesting to have a different discussion later. That my sense is that the way the technology is moving, it's going to an information-driven society. So lots of the traditional functions banks did actually can be unbundled. You can basically atomize that, and you can have specialists, information specialists for credit evaluation, for liquidity, for pooling. And in that kind of world, I wonder how conventional monetary policy is going to work.
I think that's a very good question. Broadly, what I'm going to take is, see, in general, far more disintermediation. And I think the parallel that you have created, disintermediation is like peer-to-peer lending. Essentially, that's the, so as the proportion of disintermediation will increase, and my sense is that it will never go to 100%. There will be there will be money creation by banks. Banks will even with technology there will basically be banks, because apart from what you're talking about, which is the fact that some of these unbundling and therefore use of technology, but the same use of technology will also make the the credit evaluation, the monitoring of lending, all of that much easier as well for banks, and thereby also enhance the money creation function in banks as well. So these basically will be sort of working counter to each other. So I don't foresee a time anytime soon, at least in the foreseeable future, where money creation by banks will not happen. It will happen. And I'll give you an example from India now. For instance, I was mentioning it to the governor and to His Excellency the President as well, that in India, for instance, if you look at the number of digital transactions that happen in a day, if you take the number of digital transactions that happen in the United States, add the number of digital transactions that happen in Europe, add the number of digital transactions that happen in China as well, and if I'm getting my numbers absolutely correct here, multiplied by 2, India's digital transactions are more than twice the combination of these 3. So in practice, what does that mean? I actually, when I go to buy bananas, for instance, I've gone, I pay 50 rupees. I basically pay using digital money. Now that banana seller is having therefore the trail of money that he's getting, I am paying him, others are also paying him. He can show, when he goes to the bank, he can show, this is my actual revenue, look at the records. You can go and check with the bank, and that therefore gives him the opportunity to take a loan. He's a fruit seller with just a cart. He can go and take a loan, which actually hitherto, when he was just using cash, there was no way for him to go and take a loan. Or similarly, somebody who's actually selling, let's say on the streets, clothes or belts or whatever, he can take a loan to create a shop now. If this fruit seller wants to move from a small cart where he's selling fruits to a shop, he can go and take a loan, and that creates the opportunity for money creation and therefore output creation, GDP growth as well. So I think these are aspects that actually technology is enabling, and therefore money creation through banks as well.
Your example, has that led to more credit going to the subprime?
So again, good question. So the last 1 year, credit creation has increased significantly, in the Indian economy. It has not happened as much as it can, partly because, and this is one of the things that I keep talking about in India. The Indian banks, especially the public sector banks, still do not use adequate technology. They, for instance, when I've said this publicly as well, so I'm happy to say this. I use this parallel from cricket. I like giving examples from. I don't know whether you remember, but we had a cricket team in the 1990s led by Mohammad Azharuddin. This cricket team, any team from whether it's a subcontinent, Australia, New Zealand, anybody came on tailor-made pitches, Anil Kumble, Venkatpati Raju would basically defeat them in 3 days. But this team, when it went outside of the Indian subcontinent, when it went to Australia or South Africa, it basically used to fail dismally. my parallel is our Indian banking sector to a large extent is still like Mohammad Azharuddin's cricket team. It is not like Mahendra Singh Dhoni's cricket team or Saurav Ganguly's cricket team, which has basically gone and earned laurels in the world, competing globally. It is because technology, use of technology, for instance, even retail, even if we take the private sector banks, for instance, private sector banks have actually used technology for retail lending. But when it comes to lending to SMEs, small and medium enterprises, really micro enterprises, or even large borrowers, for instance, there is very little use of technology, to be, and one of the key ways in which technology should be used is, one, to of course remove the problem of adverse selection, at the time of, when giving the lending. Another is also to alleviate the problem of moral hazard after the loan has been given. One of the key ways in which actually a lot of, willful default happens, in not only in India, but happens elsewhere, is through related party transactions, which is a borrower borrows, and then does some, buy low, sell high kind of transactions, which is not visible, and effectively then money gets, becomes related party transactions become a conduit for the money to be swindled. Now, technology can be used to actually track this, but has not been done as much. So, short answer is, yes, it has improved, but has, the potential for credit creation, that this infrastructure, digital infrastructure has created is far, far more humongous than has been realized at this point in time. Partly also also because there aren't enough, bankers who actually understand the power of technology really well. I think if we have on the bank boards and CEOs who know the power of technology and finance, I think then this can be solved.
There's one last question, so we have to finish it off now.
Thank
Please.
you, Doctor. As per my understanding, the money multiplier over here. As per my understanding, the money multiplier has more component. It's not only the reserve requirement, the currency to deposit ratio plus 1 divided by reserve to currency deposit ratio. So that means the money multiplier may if affected by both these factors. So therefore, even without any change in the currency to SRR, there could be the incidences that the money multiplier can change. So my reading in the US, during this the global financial crisis, they did not change their SRR or the CRR, but they changed the policy interest rate and all, and they took the regulatory measures like Sri Lanka. So those factors can influence the money multiplier. So what is your view on that?
Yeah.
And another point. So you take about the equation MV equal to PV. So in theory, we take the V as constant.
Mm-hmm.
But if you look at the COVID period and the global financial, particularly the COVID period in Sri Lanka, the velocity declined drastically. So what is your view on that?
Yeah, thank you. So let me answer your first question. See, the key point that we are making, is that when you take the monetary base and you take the broad money, and empirically the money multiplier is just the ratio of these two variables, the broad money to the, that's how it's calculated. The point we are making is these are two independent variables that are basically, the monetary base is being decided by the central bank policy, and the broad money in the economy is actually being determined primarily by the lending by the banking sector. These are dancing to two completely different tunes. Now, what you talked about is actually, that is not it's not theoretically shown. It is empirically, people have said, finding that, the 1 by the reserve ratio does not seem to explain the money multiplier very well. Let me put in the regression, let me put the policy rate, let me put something else. And, now that particular, that may prevail, for instance, at some point in time, but it may not, that particular equation may not be very stable as well. So the point we are trying to say is, when you have two independent variables, which is your monetary base and the broad money in the economy, moving to two different tunes, whatever ratio you get will actually, that'll be, it is just a artificial ratio. which will not have, which will not have, that much relationship with the underlying variables. That is the key point that we are really making, that the broad money is determined by the, by the banking sector. And even if, let's say, you take in, other variables, one of the key variables is the reserve ratio, because conceptually, it's, if you remember your, the economics classes, how is it derived? It's basically derived as a geometric progression. You actually start, 100 rupees, basically then 100 times 1 minus CRR, then plus 100 times 1 minus CRR squared, and so on. That's how the conceptual derivation is done. Then you come up with basically saying, well, the sum of the geometric progression is basically the multiplication is 100 over CRR. That's how you derive it. That does not seem to work at all. Even if, let's say, other variables do affect, it can't be that, CRR has been decreased from, for instance, from 9% to 5%, and you have the money multiplier at least increasing, it actually has decreased. So where is the, and the entire literature on, monetary theory, it calls this basically a puzzle. Why is this that the point, our resolution of that puzzle is saying that these are two independent variables that are dancing to two different tunes, one to the central bank tune, another to the tune of the banking sector. So if you do a ratio on that, that will not have much to do in the with the underlying variables. In fact, in the book, and if you are interested, you should, we show the money multiplier can be 1 by CRR. It could be 1 by the cash reserve ratio plus a statutory liquidity ratio. It can be infinite. It can be 0. It can be even 0 by 0, indeterminate, depending on whether the, what is the kind of operation that is done. Is the, for instance, securities, is the central bank borrowing from, is it basically doing these operations with the banking sector, or is it doing with the non-bank private sector? Depending on, if any of these multipliers is possible, then where is the theory of money multiplier really? So that's sort of the derivation of those you can read in the book. But that's, I guess, the key point being that we should think about these as independent variables.
Yeah, so thank you very much, Professor. We took a lot of your time for the post-discussion and also the very constructive comments and discussion. So let me conclude, and again, thank you, Professor. So over to the
Thank you very much, Governor.
Now let me invite the Senior Deputy Governor of Central Bank of Sri Lanka, Mrs. Yvette Fernando, to deliver closing remarks for the program.
Good evening, everyone. Dr. Krishnamurthy Subramanian, Executive Director of the International Monetary Fund, Dr. Nandlal Veerasinghe, Governor of the Central Bank of Sri Lanka, the distinguished invitees, members of the Stakeholder Engagement Committee, my colleagues at the Central Bank, ladies and gentlemen. It is my honor and pleasure to give the closing remarks at this important event, where we all had very thought-provoking presentation delivered to us by Dr. Subramanian. In fact, when I was informed by an email to take these closing remarks, I kind of thought to myself, why me? But I think at the Central Bank, I'm the best person to deliver this thank you to you, being responsible for the financial sector supervision and regulation. And I'm very thankful for those very concluding remarks that you made to reiterate the importance of the supervision and regulation of banks, as well as the importance of banks, especially at a time we are in a transitional period, looking at a new Central Banking Act, and also looking at a new era for the Central Bank, together with Central Bank independence. So indeed, compared with past years, monetary policy in today's world has changed and become more proactive and dynamic, with changes in terms of policy decisions and measures, policy instruments and procedures, policy frameworks, and more importantly, reliable forecasting methods. The same objective of attaining price stability remains, but the means by which it is achieved, the toolkit used for this purpose, and the expected actions and reactions to events in the economy has changed. Nowadays, instead of one tool, the policy interest rate, central banks around the world use several different policy tools, both in times of crisis and in more normal times. As central bankers and policymakers, we need to stand ready to effectively use the available tools, perhaps use those more innovatively, and even go to the extra length of developing new tools and improve analysis so that we could fulfill our mandate more efficiently. If the world changes, we need to change with it. So the insights shared with us today by Dr. Subramanian are greatly beneficial at a time when we are attempting to restore macroeconomic stability and normalcy in our country. The views and thoughts from your speech will surely support us to be more effective in implementing policies to restore price stability and economic stability while ensuring financial system stability and propel the economy towards a sustainable growth path in the period ahead. Therefore, on behalf of the Central Bank of Sri Lanka, let me once again express our profound gratitude to Dr. Subramanian for accepting our invitation to deliver this lecture. We are certain that you will have a pleasant stay in Sri Lanka and engage with fruitful discussions at this crucial juncture of our economy. Let me express my sincere thanks to the audience who present here, including the distinguished invitees, for accepting our invitation and being present. Finally, I thank the staff of the several departments at the Central Bank who assisted to organize this event. Thank you and have a good day.